Well, those of you that have watched these videos over the last few months will be very surprised to see that the standard blue tie is gone and that I was able to get out and buy a red tie in lockdown Melbourne. So the red tie is probably indicative of the celebrations that are going on in Victoria at the moment, and it's a very key factor behind the results of the consumer sentiment survey we see today. So we saw a 2.5% jump in consumer sentiment in November. That takes the index to a 7-year high. It is now 35% above the August level, and despite the fact that we saw a 32% jump in the 2 previous months, the index was able to rise a little further. Key driver here was a 9% jump in confidence in Victoria, and of course the key factor behind this recovery in the index has been the announcement of the reopening in Victoria that we saw a week or so ago. During the survey week, we also saw the Reserve Bank slash interest rates to record lows. And most importantly, the Reserve Bank Governor indicate that he doesn't expect to be raising rates for at least 3 years. That's meant that banks have responded by pushing the fixed mortgage rates down to less than the psychological barrier of 2%. We've also seen a strong signal around Christmas. I would imagine that 2 months ago people were expecting a very unusual Christmas. So the question that we've been asking now since 2009, are you expecting to spend more or less on gifts for Christmas this year? I was concerned that we'd see a substantial drop in people's expectations of their spending patterns. But what we saw is we saw the so-called normal result, where around 30% say they'll spend less and around 10% say they'll spend more. So that negative net balance of -20 compares with the long-term average of around -21. So indeed, what we can say is that despite all the uncertainties and the volatility we've seen this year, spending intentions indicate that we're heading towards a normal Christmas. When we look at the components of the index, most of them of course were quite strong, but we did see a negative on how people assessed their finances. And I think that was a result of the scaling back of JobKeeper and JobSeeker from September. And we haven't actually benefited yet from the tax cuts. Those tax cuts will be coming through in the second half of November. The other interesting aspect of the components was a 6.7% jump in the question, is now a good time to buy a major household item. So despite the fact that retailers have been having a pretty good time in terms of the household goods area, there's expectations that this will further improve. That's the best level of the index since we've seen since the middle of last year. We also rely on this survey to get an indicator of how the labour market is performing. And there the results weren't so good. People were less confident about the unemployment rate falling to the tune of around 7%. That index is still about 10% better than it has been over the pre-COVID period, but certainly indicating that the thing that will bear most watching for the economy will be how the unemployment rate plays out. And in that regard, the big story has been a sharp lift in confidence in the housing market. So the question that we've asked since the survey was first introduced in the mid-70s, is now a good time to buy a dwelling, lifted by 8%, and that's the strongest number we've seen since November 2013. So consistent with the overall index, confidence around housing is at a 7-year high. And we saw strength in all the major states, so New South Wales and Victoria, in that sort of 5 to 10% range increase. Also, we asked the question about the outlook for house price expectations. And that index that took a shocking hit with the introduction of the shutdowns recovered today by 12%. So it's getting very close to the pre-shutdown level now, and indicating that in particular in Victoria, house price expectations are up by 20%. So when we put everything together on this survey, I think the story that for me is the most significant is what we're seeing on the housing market. To see such a sharp jump in time to buy and in house price expectations is unusual, and it's saying that the negatives that we see around the housing market of high unemployment, concerns about deferred loans, scaling back of JobKeeper and rising vacancy rates have been offset by those record low interest rates and by the indication that interest rates are unlikely to rise over the next 3 years. So I think in the short term we'll certainly see further strength in the housing market. We'll see a normal Christmas, but next year may bring some more surprises given that we're going to be going into next year with an unemployment rate near 8%. Thank you very much.